Morning, everyone. This is Tom Vilord from Wall Street Value. I wrote an article yesterday regarding the events of Monday evening, Tuesday morning. Kim Jong-un is an idiot, and he acted that way again because he launched a ballistic missile towards Japan. Now, he proved to us once again that the guy's a head case, and he has the means and the desire to launch a missile towards Guam, which is a U.S. territory. So how does that affect the market? How do his actions affect us now and going into the future? So the market yesterday opened up down 118 points. By the time I was done writing the article, it recovered all that, and it closed positively for the day. So fortunately, the jitters were minimal. However, there were some people who were nervous, and they rushed into gold. So gold opened up over 1% yesterday. Now, here's my opinion on gold. Take it for what it's worth. This is my opinion only. It is not a recommendation. Tom Vilord's not your advisor, so I cannot and will not give you advice. So to me, gold is a hedge. Gold over the long term has performed a little bit better than inflation, but has definitely lagged the equity market. So for the long term, if you want to earn potentially higher returns, put your money into equities, not gold. So gold over the 5-year average, over the last 5 years, has averaged a negative 5% rate of return, whereas the S&P 500 earned a little under 14%. Over a 10-year time period, gold has returned 6.6% compared to the S&P 500, which has earned 7.7%. Now, I'm comparing the gold ETF GLD to the S&P 500 ETF SPY. So, a couple things here. If you want to figure out how to play these actions, there's two things you can do. Number one, you can buy an aerospace and defense ETF. So President Trump said he's going to allocate $550 billion towards defense and military spending. So that's $550 billion, and according to him, it's going to be the best $550 billion ever. So there are four ETFs that I think are pretty good. One is the iShares Aerospace and Defense ETF. The second one is the PowerShares Aerospace and Defense ETF. Then you have the SPDR S&P, and lastly, the Direxion Aerospace and Defense ETF. Now, if a diversified ETF isn't your thing, then you can invest in some of the individual companies that make up the top holdings in these ETFs. For those that don't know what an ETF is, it stands for Exchange Traded Fund. I love ETFs. They give you a nice basket of companies. Now, you can pick a sector-specific, such as this one, or a broadly diversified ETF, such as the S&P 500, the NASDAQ, or Russell 2000. They're very diversified, and the fees are extremely low, especially when you compare them to mutual funds. But if you don't want to buy an ETF, you can pick some of the top holdings, as I mentioned, and some of those top holdings are Boeing, United Technologies, Lockheed Martin, Raytheon, General Dynamics, Ball Corporation, Honeywell, L3 Technologies, and a lot of other names in that sector. Now, when it comes to investing in an ETF, the one thing you have to be careful of right now is that we're at a time where the market is just about at an all-time high. So when you're investing in these ETFs, a lot of the companies that make up that portfolio are going to be overvalued, and if you're lucky, fairly valued. Now, as value investors, we don't want to buy anything that's overvalued. We don't want to pay more than what something is worth. We don't even want to pay fair value for a company. We want to make sure we're buying great companies, and the companies that I just mentioned, Value Line has most of them rated as an A++ for their financial strength rating. So we want to buy great companies such as these, but we want to buy them at a discount. So how do we play these events when the market is not at a discount? So here's what I'm doing. I'm picking a couple of these companies, and one of which I'll give you as an example is United Technologies. A++ company on Value Line, solid financials, great long-term performance. And I bought the shares originally back towards the end of 2015. And my cost basis was $86. Now today they're trading at 117 bucks. I don't want to buy more at this price. However, some people may think that $117 a share still represents a bargain because Morningstar has a price target of 129. MSN Money and TipRanks has a price target of 130, and Yahoo Finance has a price target of a hair under 128 per share. So there still has some room to grow for United Technologies, but I don't want to buy it at that price. I want to buy a little bit cheaper. So I can either wait for a pullback and then buy some shares when it pulls back, if it does pull back, or I can sell a put option. And when I sell a put option, I am obligating myself to buy shares of United Technologies at a specific price anytime between today and a future expiration date. So the expiration date that I selected was 1 year from now. So I'm looking into the September 2008 expiration, and I'm looking at a strike price of $110 a share. Now, it's still not a huge margin of safety, but it's a great company. It's going to be undervalued. And the reason I'm doing this trade is because I can collect $5.85 per share to put this transaction on. Now, if United Technologies from now until 2018, September of 2018, if the stock goes up, if the stock stays flat, or if the stock goes down, just not down below $110 a share, I don't have to do anything. I don't have to buy any more shares, and I collected $5.85 for that obligation. Now, since my original shares that I purchased were $86, I'm bringing my cost basis down close to $80 a share. So I made $5.85 without having to do anything. I didn't have to put more money into an investment. I just sat there, collected some money, and if you're using portfolio margin, 50% or 30%, if your broker-dealer allows that, you can get pretty decent rates of return without doing anything. Now, that's a win, but what I'd rather have happen is the stock to go down. I want to buy more shares, and I want to buy it at a better price. So if the stock goes down below $110 a share, now I have to buy it. Now, my cost basis isn't going to be $110 because I collected almost $6 a share in the premium, so my cost basis will be a little bit over $104 a share. So that is how I am playing the events with North Korea. I think there's a lot of great companies in the aerospace and defense sector. I don't think there's a lot of great companies at good prices. So by selling the put options, you're creating that margin of safety. And if you get put to stock, that's great because we're buying the companies we want to buy at a better price. But if we don't get put to stock, we collected premium and we made money without having to do anything. So that's why I'm doing this. Thanks for watching. Stay tuned, and I'll talk to you guys later.